Hi there. We're going to do some depreciation work. We have three methods, straight line, double declining balance, units of activity. I have comprehensive solutions here, but I actually want to focus on just answering question one um, as quickly as we can without doing, a full-scale comprehensive solution. We're just going to find the book value of these assets, of this equipment. We have a scenario where we buy a new vehicle and we have given data here regarding the asset. Let's focus on straight line. The first thing we're going to do is we're going to show the $55,000 purchase price we call our historical cost. This is always going to be on our balance sheet for all the methods. And then we take to get to our salvage value, we know is 4,600, which gives us a depreciable cost or base, a depreciable base of 55,000 less 4,600. Whoa. And that helps us know we're going to use this to depreciate, because when we get to the end of the 5 years, we want our book value to match salvage value. What's salvage value? Salvage value is the scrap value, or what can we get rid of this delivery vehicle for at the end of the year. We're expecting we're going to get $4,600 from someone we sell it to after the useful life. So with that said, I'm going to now create a depreciation factor. So 100% of the depreciation divided by how many years? We have 5. I'm going to write depreciation factor for straight line right here. And now I'm going to calculate annual depreciation, and then of course I can do monthly depreciation because we have 12 months in a year. So I'm going to take this, I'm going to say the depreciable base times this. That's also dividing it by 5, of course, because we have 5 useful years. So our annual depreciation we're going to depreciate is this, 10,080, and then we have 10,080 divided by 12 to get to our monthly depreciation. The question asks us, what is the book value of this asset after year 3? Well, let's remember that this equipment vehicle, this is on the balance sheet, right? This historical cost is always going to be shown here, and then we say less accumulated depreciation. And what is that after 3 years? Well, we would take 10,080 times 3, and that would get us to equipment net, the net book value, this minus this, and there we are, right? So what is the accumulated depreciation after year 3? It's 30,240 because we took 10,080 times 3. And what's the net book value or book value of the asset or accounting value of the asset on our balance sheet after year 3? 24,760. Now remember, we can't come back over here and bring this 54,000 here because we bought this for $55,000. We're depreciating it based on this value. So at the end of its life, the end of 5 years, at the end of year 5, it's $4,600, right? I go into this comprehensive solution. Here is a depreciation schedule for straight line. So we've solved it. Now let's do it for, let's solve this for accelerated depreciation. The first thing that we know, or double declining balance, the first thing that we know is that we don't use the depreciable cost now. The purpose of double declining balance is to accelerate depreciation in earlier years. Let's assume an asset, or we use double declining balance for an asset where the usefulness of it is most used in the early years. I've given the example of coal drilling equipment that where the very expensive bits to drill into a mountain, they're really useful in the first year and they're less useful in year 2, and then they become and then they become very less useful in the final years. So how do we create what's our depreciation factor? Our depreciation factor is twice that double of straight line. So if I take the straight line factor times 2, I'm going to have 0.4. Okay, sorry, I had some sound issues there. Um, so our depreciation factor is going to be twice that for double declining balance of straight line. And we're not going to use to create annual depreciation. We're going to use the historical cost because the purpose of it is to accelerate depreciation by making a smaller depreciable base that's counterintuitive, not in the same logic train. So we're actually going to use 55,000 divided by, or 55,000 times this in year 1, and then I'm going to say, depreciation 1, and then I say 55,000 minus this gets me here. And then I'm just going to continue on 33,000 divided by this, or times it by the depreciation factor, plus this minus this, plus this times the depreciation factor. So what is this equal? This is the depreciation, and this is the or no, excuse me, this is the net book value of the asset because that determines on we need to have the net book value. So 55,000 minus the 22,000. How did I get 22,000? My net book value of the asset is 33 times that 33,000 times 4 to get the next year's 32,000 minus year 2, year 1, year 2, year 3. So if I were to create the same, balance sheet view here for depreciation, I would say equipment is the same, of course, 55,000, and I have depreciated in these 3 years those amounts. You'll notice that more depreciation is in the earlier years. This is an asset useful life is much better in the beginning years. What's the net book value? 11,880. Let's check our work. Here's the comprehensive schedule, 11,880. Remember, I'm trying to do this as quickly as I can. I've answered this without having to build a full schedule. What's the key here to remember? We do not deduct the salvage value for accumulated depreciation or for double declining balance or accelerated depreciation, which we are only going to do double declining balance. We double the factor. We took 20 times 2, and we had to build out the 3 years as follows here to get how much we depreciated. We were given this data here for units of activity. Units of activity, we are going to deduct, we are again going to deduct the salvage value like we did in the straight line. So I'm just going to paste that here. So what we're going to do now is our depreciation factor is going to be 50,400 because we do deduct salvage value because we want the asset to be 4,600 at the end of its useful life because that's what we believe we can salvage. And then we're going to divide this by the number of miles in the useful life, which was 100,000 miles. So our depreciation factor .
depreciation factor is 0.5040. And if I were to quickly solve this, I would actually just take all three of these years. Let's say this times this. That's the depreciation year 3. And then I'm going to build another schedule here where I say the first the equipment is always going to be 55,000 historically. And I'm going to deduct 27,000, which is 54,000 miles times the mileage depreciation factor. And there we go. If I come over here to 27,784, here's my comprehensive solution. Tie it out. That is finding net book value, which also helps us find accumulated depreciation. We have to have the accumulated depreciation after year 3 to find the net book value, accounting value, or book value here. And we have done it for all three. Straight line.